Welcome back to Golden Rule Radio. Hi, Miles. Hi, Tori.
Hey, Robert.
Hey, guys.
Good to be back.
I'm going to kick off this week's show with the S&P 500 chart. It has provided some geometry in the chart that I've pointed out here to Miles and Tori today.
A little symmetry, so to speak.
A little symmetry. But basically, it's illustrating the difference between the bottom and the top after a decline where it kind of chops around and trades in a range. And once it breaks out of that range, whether it breaks up or down, it's then going the distance from where it broke out and going the distance between what it was chopping around. I know that might be hard to visualize, but we'll throw the chart up here and let you see it. And the point of it is that we just completed the last distance from the breakout of it chopping around, and 3120 on the S&P, that's where that had predicted that was going, and we just hit it, and it's showing some resistance there, and it looks like it wants to turn around. We've had the VIX kind of popping up a little bit, and looks like the stock market might be ready to roll over.
Sure, and I mean, you can translate that over to the Dow as well, where with the S&P and the Dow both, you've seen these breakouts of that rising trend line. In the S&P, you're pointing out this very unique symmetry, or I guess maybe unique's the wrong word because it seems to be following the same pattern back and forth, right? I mean, same time frame for it to make those exchanges up and down, and then certainly the same height as far as how much percentage-wise it's moving. The Dow, you look at the trend line that it broke through on the top end, and now we've been bouncing along that top end trend line. So, I always say resistance becomes support when you break through, but we need to have a retest of that, and which would mean the Dow needs to push quite a bit higher and then come back down to it. So pulling in some of these other potential indicators, it's always a good idea when you're not entirely sure what a market's doing to maybe go check the tea leaves a little bit and check with some other experts that trade differently than you do. So bringing something like this in to say, even though we've had this breakout up in the equities market, that doesn't necessarily mean we've got a continuation going up yet.
And you've had huge distribution days, meaning institutions selling into the strength of the market.
Right. And with end of year coming up, it's not surprising to see some of this pushing up. I mean, retail sales numbers are going to start coming out here after Thanksgiving as we push into Black Friday, and we'll have to see how that affects things. But what scares me, if we can transition over to the transports as well,
yes,
is the transports.
And the Russell is not broken to a new high. Is that where you're going with that?
Yes, and not only that, I mean, we're looking at the transports. Not only did they come up 3.5% of their previous high from last year, we're now down 8% off of that. I mean, the transports this month have just fallen off a cliff. So if we get down to about that 10,400 level on the transports and then push below that, you could be looking at probably a couple months of bearish movement on the transports. And coming into the big retail buying season, that makes me very nervous for what the economics look like. And when that transposes over into the NASDAQ, further into the Russell, into the Dow, if those companies aren't selling stuff, they ain't shipping it, they're not making money. So where's that investment money coming from? And we'll pass it over to Tori, who's going to give us our bailout money update for this week. So, Tori, how much free money has come out of the Fed coffers this week?
Well, just $140 billion.
Okay,
Miles.
Good. So we're fine.
You've got nothing to worry about, whether the transports slow down or not, or the markets roll over. You guys, what are you worried about? You have endless supplies of dollars backing it from the Federal Reserve to the tune of right now $189 per person, every man, woman, and child in the United States. And on that subject, I would point you this week to the McIlvaney Weekly Commentary, where they do a really good job of covering that repo market effect. That is a behind-the-scenes stabilizing of a very unstable market. So I shouldn't say stabilizing. I should say intervention in a very unstable market.
And it doesn't just have to do with the U.S. banks either. In fact, there's some good arguments out there saying that a lot of this repo market is because we can't cover the overnight carry because of the crises over in Europe right now and some of the banking industry problems that they're seeing. So this is a global issue. It's all falling on the shoulders of the Federal Reserve Bank, and we'll see if Atlas shrugs.
Well, you guys right now, too, you got to understand that it's not just the repo market. You've got $23 trillion in debt. It doesn't matter if you can afford to pay for something or the market's turning down. I saw a number the other day, the war on terror since 9/11 has cost us over $6 trillion, right? What can you do with $6 trillion to stabilize an economy? And so numbers almost just seem not to matter anymore. But it is very, very important because we're talking about people's retirement assets, savings being depleted here. And that's, again, why you diversify your portfolio into numerous categories.
So if you are just sitting in the stock market, like possibly some of you are, you might want to be cautious, might want to be taking some money off the table because it continues to have distribution days. That's very significant with institutional money getting out of the market as it's kind of grinding higher here. And that's similar to what we saw in 2007 and 8 going into the last crisis. Also, what is similar in that time frame was that gold kind of started going up out of nowhere.
That's right.
And that's what happened this year. So
while you had bubbles forming in those other asset classes, gold was telling the story.
Big money knows what's coming.
Big money knows what's coming. Smarter money, I would say, has already come into the metals market. And we have talked about this trend ever since we started the show a few years ago. And we're approaching that time of year again. You guys know what it is. It's the end of the year. And every year in the last 5, maybe even 6 years, we have had a bottom formed sometime in this last fourth quarter of the year. We may have already just seen the bottom with gold. It completed a little 1, 2, 3, 4, 5 pattern and is starting to rise off of that. And if it follows this trend, it doesn't have to, but the last 5, 6 years it has, it starts going up towards the middle to end of December or January, and then it rises. And that's what it looks like gold wants to do here, is we're completing a down wave here. Mm-hmm. This is the opportunity. This is the window. If it moves a little lower, look at your bank account, figure out how much you can spend, and put money into the metals market. Give us a call. We can talk to you about a recommendation. That's what you need to be doing before you get into Christmas time. You've got about a month.
I totally agree, and it is absolutely encouraging to me that gold's up. Let me ask the listeners just a question. Why is gold up 15% this year when you have all the major indices setting all-time highs? So if those markets are an indication of economic viability and health, why is gold up 15%?
I'd give our listeners a little credit, Tori. You read the comments, you know they know the answer to that.
No, I
mean, it's pretty
know.
apparent, right?
Smart money, institutional money, central banks have been buying gold this year, and it's pushed above the past 6-year high at $1,375. We haven't even looked back on that number. We hadn't talked about that much, but I'll mention that again. $1,375 for 6 years was the high.
Huge. It was
we busted
huge.
right through it this summer, and we've been holding above it ever since. We're $100 higher today from that number. We haven't even tried to push down and come back down to that level. That means there's been follow-through buying in the gold market. The smarter money knows what's coming.
And that's the scary thing, because if you look at the gold chart over this past summer, we're down to the very first potential support level only. You know, we've had our compression, we've had this 5-point, which we will draw on the chart here so you can see this 5-point movement in the gold price as we've compressed down. But the downwards movement we've had has been almost nothing. You know, you go up $300 in gold. If you're not coming back 150, 200 of that, if you're not getting a 50% or even a 618 fib retracement there, you're in a very, very bullish market, even if it does just stall here for a bit. So that's what frightens me. And we saw that back in 06, 07, leading into the crash. Now we had, and I do want to bring this up because I think it's worth mentioning, the CNBC article we saw this week, but we did have that big drop in gold right when the stock market fell apart in 2008. You know, everybody remembers gold going from 600 to almost 2,000. What we forget is it was over 1,000 first.
And then pulled back.
Pulled back to roughly 700 and then shot up. So, and that's where you have to bring in this concept of the differentiation between owning real physical metal and owning fake paper promises.
I think I know where you're going with that, because when gold pulled back to 700, you couldn't buy gold at 700 or 750.
No, of course not.
You were paying 9 something, so you had a premium. Basically, the physical market just quit
Dried
going
up.
down.
It
It
was
didn't
gone.
follow spot down, and then it recovered and still finished the year higher. You just had a very temporary blip there because you throw the baby out with the bathwater in the markets, I guess.
Yeah,
So
and
you
the
look
dollar
at-
rallied strong, remember, at
Right.
the same time. And we're seeing a strong dollar environment right now, despite, you know, what you would think that you would be seeing gold pulling back with this strong dollar environment. It's not at all.
So CNBC had an article out today discussing the 15-year history of GLD. They're very careful not to go too deep into the fact that HSBC Bank uses that gold as offsetting collateral to short the market. So here's what's scary. Think about this. That gold is tied up as a collateralized short position, or collateral on the other side of a leveraged short position. Gold goes up $300, that's illiquid, because HSBC now has to liquidate off the GLD physical position to cover the short sale on their short holdings. So it's the problem with programs like that. While they're cheap to get into, all you're really doing is just speculating on the price. And when things start moving, premiums start moving, and product dries up, it becomes very difficult to get your hands on it.
Well, the other thing about the GLD, in their own report, it says clearly that the custodian is HSBC. Hong Kong Shanghai Bank of China is what that stands for.
Some good stuff going on.
Who wants to
right
invest
now.
there? Well, if you are invested there, that's not really a gold holding. You don't own real gold.
And you don't know where it is.
You don't know where it is. Why? Because in their own report, they say that gold can also be held by sub-custodians. Those sub-custodians do not have to be insured or bonded. Did you hear that? They don't have to be insured or bonded. It says in their own report that the counterparty risk is significant because the gold could end up in the hands of a sub-custodian, and the fund, the HSBC, is not responsible for what that sub-custodian does. That is crazy to have that as a holding and call it a gold holding. It's just not a gold holding.
It actually explains, too, why there was such panic and fear in that ETF market back in 2013 when you started seeing so many physical ounces being delivered as contracts matured, and they had to put a stop to it. That's when you saw margin increase, requirements and everything else through the CFTC, because I think they had to stabilize that ETF market. You cannot account for the location and the exact number of ounces backing those ETFs. So transitioning over to silver, let's take a look at this week's chart on that and fill us in a little bit.
Well, now we're pulling the bowstring back, right? I mean, we're talking about gold not really pulling back as far as we would like. I mean, and again, just closing out gold, I'd love to see 14 and a quarter. 14, 15. I'd love to see it get lower. There are great arguments that it doesn't. I'd really like that to happen, but we're running out of room this year. Got 5-6 weeks to go, and then we're starting next year. And historically, as Robert's pointed out a couple times in the show, December lows, you don't hit them, you ain't going to get one till next year.
You want to be in before the first of the year.
So where have we pulled back the bow? And I think that's a great transition over to silver. I think silver still has a little ways to go. I mean, it's stair-stepping down as gold is, but it has come down percentage-wise more than gold. Where gold's just hitting that first consolidation or that first support level at the 382 fib. Silver's broken through the 50% line. The 618 looks real good to me. Lines up with some previous support and resistance levels. So a little bit of a rise in silver, and I think I called this last week around 1635, and that's still my entry point on silver. So I'm still hoping for that. Now, the reason I'm still hoping for that is because of what platinum's doing. Platinum has crushed it this month. Platinum came all the way down to that lower support, that declining support. Looks almost identical to silver, just a month ahead of it.
Yeah, and it touched the 618 perfectly when it pulled back.
Right. Like to the penny.
Right at it. And it's bounced off of that, and then it got back above that trend line, and it looks strong.
Right. So we need to see platinum, platinum up around 930, 940, testing some of those previous highs. But that's a compressing pennant, and if we end up getting to that and breaking above it, you're going to have a breakout in platinum. Breakout in platinum signals the breakout in silver is probably soon on its heels. So right now, if I'm recommending anything, pick up a bag of junk silver. The premiums are low. Pick up some 100-ounce silver bars. Put something into your silver position, especially if we get down to 1650, 1635. Because if platinum breaks out, silver is quick on its heels. And when that ratio plays catch up, you're going to want to make sure you've increased that position.
So before we wrap up, we'd be remiss if we didn't mention the release of the Fed minutes today. Basically, nothing's changed. They see little need for a rate decrease. What a difference a month makes, and what a difference 3 days makes, because 3 days ago, Trump was very excited about his sit down with Chairman Powell, and they talked about negative interest rates and lower interest rates. And they talked
he's
about
extra
debt.
Purple today.
Yeah, he talked about, weakening the dollar, and he sent out a tweet where he was very excited about the way the talk went. But nothing happened in the Fed this week, but I will tell you this. Those are all red flags. If you think that debt isn't an ongoing concern, if you think that spending isn't an ongoing concern, if you think that future negative interest rates aren't an ongoing concern, then you're not listening to the tweets that are coming directly from the White House. So keep that in mind. And let's talk briefly. There will not be a show next week due to the Thanksgiving holiday. So we wish all of you and yours a very blessed holiday. And with that, we're going to wrap it up.
So we appreciate you joining us this week on Golden Rule Radio. If you liked what you heard, hit the subscribe button, ring the bell. There's also a neat little share box where you can copy paste a link onto 10 of your best friends. Suggest you do that. You can also head on over to our website, McIlvaney.com, to learn a little bit more about our investment strategies in the precious metals. You can visit Twitter at ICA Gold or Facebook, McIlvaney Financial. And as always, if you'd like to discuss your personal portfolio with us or one of the advisors here at McIlvaney ICA, you can give us a call at 1-800-525-9556.
Thanks for listening. Happy Thanksgiving.